billionaire wealth surged by $2 trillion in 2024 alone. That's 3 times faster than the previous year. At this rate, the world will produce at least 5 trillionaires within the next decade. The numbers sound like success. Markets celebrate. Headlines declare prosperity. But strip away the noise and a different pattern emerges. This isn't the first time extreme wealth has concentrated this rapidly. It happened in the United States during the Gilded Age, when railroad barons controlled the nation's infrastructure and declared the public be damned. It happened in the late Western Roman Empire, when the richest citizens abandoned their civic duties and fled to fortified estates while the state collapsed around them. It happened in Japan during the 1980s, when corporations gambled borrowed money on inflated assets until the bubble burst and triggered decades of stagnation. Each time, the concentration looked like strength. Each time, the elite believed they were exceptional. Each time, the pattern ended in systemic collapse. The current billionaire boom isn't random. 60% of this wealth comes from inheritance, monopoly power, or political connections, not productive innovation. The mechanisms fueling this surge are identical to those that preceded every major economic implosion in modern history. The United States has now entered the late stage of this cycle, replicating the precise conditions that destroyed 3 separate civilizations. The question isn't whether collapse is coming. The question is whether anyone will recognize the pattern before it's too late. To understand the danger, start with the source. Modern billionaire wealth didn't emerge from competitive markets or breakthrough innovation. It emerged from structural capture. Oxfam's analysis reveals that 60% of global billionaire wealth derives from inheritance, monopoly power, or crony connections. 36% is inherited wealth, establishing a new American aristocracy where success depends on birth rather than merit. For the first time since 2009, every billionaire under 30 inherited their fortune. The remaining unmerited wealth comes from monopoly power, 18%, and political connections, 6%. This distribution defines a closed system where advantage compounds through structure rather than competition. The implications are profound. When the majority of elite wealth isn't generated through productive capitalism, but through political access and inherited advantage, the ruling class loses its moral and social mandate. The narrative shifts from economic success to systemic extraction. This isn't prosperity, it's capture, and capture breeds fragility. The single largest annual increase in billionaire wealth occurred in 2021, when $5.8 trillion accrued to the ultra-wealthy during the COVID-19 pandemic. Government liquidity injections designed to stabilize the economy disproportionately benefited asset owners. Policy response became an implicit subsidy to the oligarchy. The system isn't broken. It's functioning exactly as designed, channeling wealth upward while the foundation cracks beneath. Inequality in the United States now approaches levels last seen in the 1920s, just before the Great Depression. The top 1% controls 32% of total wealth, higher than France before the Revolution of 1789. The top 0.1%, roughly 130,000 households, owns more wealth than the bottom 90%, 117 million households. The gap isn't narrowing, it's accelerating. This acceleration matters because it signals the closing of social mobility. When success is predetermined by birth and political access rather than innovation and effort, democratic faith erodes. Citizens lose belief in the system's fairness, creating the social preconditions for upheaval. This concentration doesn't sit idle. It metastasizes into measurable systemic risk. Research by the Federal Reserve demonstrates that rising inequality correlates directly with increased household borrowing, higher corporate bond debt, and elevated asset valuations relative to GDP. Excess liquidity held by the ultra-wealthy flows disproportionately into high-risk asset speculation, inflating valuations far beyond real economic growth. This is the classic precondition for a financial bubble, and the United States is deep inside it. The original Gilded Age provides the structural blueprint for understanding modern oligarchy. From the 1870s through the early 1900s, the United States transformed from an agricultural society into an industrial powerhouse. But the transition concentrated wealth in the hands of a few powerful families. Rockefeller controlled oil. Vanderbilt controlled railroads. Carnegie controlled steel. These men didn't just dominate industries, they controlled the foundational networks of the nation. William Henry Vanderbilt's response to a reporter's question about public accommodation captures the era's governing philosophy. Asked whether his train served the public interest, Vanderbilt replied, "The public be damned." His subsequent defense made the position explicit. Railroads aren't run for public benefit, but to pay dividends. Humanity might incidentally benefit, but profit comes first. This declaration established the ethical foundation of American oligarchy. Private gain supersedes civic obligation. This wasn't mere business ownership, it was political domination. The Gilded Age elite operated as an invisible government of money and power. They built dynasties, bought politicians, and crushed labor movements. Theodore Roosevelt observed that while the industrial economy produced material prosperity, it also generated profound anxiety inseparable from concentrated wealth. The system created winners and losers, and the winners controlled the rules. The political structure of the era demonstrated a crucial lesson. Once wealth concentration reaches a certain threshold, it generates political immunity. Americans endured fragile economic foundations and rising inequality with remarkable resilience. But this resilience was a warning, not a strength. The system absorbed social tension until catastrophic failure became inevitable. Self-correction was impossible. Effective regulation required massive external shocks. The Panic of 1893, the financial crisis of 1907, and ultimately the Great Depression, to break the oligarchy's grip and force structural reform. The comparison between 19th century railroad barons and modern tech giants reveals a structural constant. Roosevelt noted that economic powerhouses were those who built and controlled the nation's core networks. Railroads were the first high-speed network. Today, digital platforms and internet providers perform the same function. Like the railroads, modern network operators don't hesitate to exercise market power to their advantage. The American economic structure is inherently susceptible to capture by network operators, validating the persistence of the gilded blueprint. Correction won't be heroic, gradual, or political. It will be sudden and catastrophic. While the Gilded Age demonstrates financial extraction, the late Western Roman Empire reveals the moral collapse that precedes state failure. The pattern is purposeful abandonment, civic detachment, and willful ignorance. In ancient Rome, social stability depended on the patron-client bond, where wealthy citizens provided for poorer citizens in exchange for loyalty. By the 2nd century AD, disparity between rich and poor grew so vast that these traditional bonds weakened. The poor became too numerous to control through personal relationships. The Western Empire, which ultimately collapsed, was glutted with elites and the hyper-rich. The Eastern Empire, which survived, maintained lower inequality, fewer elites, and more modest individual wealth. This historical contrast demonstrates a structural link between wealth concentration and imperial fragility. The elites' failure to address basic economic needs sealed their fate. During the middle decades of the 2nd century, colonization ceased. Attempts at land redistribution were rejected by the Senate. Legislative gridlock over fundamental issues like land ownership created a growing dispossessed population who migrated to Rome, exacerbating urban misery and creating overcrowded, unsound housing. The Roman failure to redistribute land or create economic opportunity mirrors modern legislative paralysis over social safety nets and tax reform, revealing a fatal breakdown in elite utility and legitimacy. The terminal stage of Roman self-interest is embodied by Rutilius Nematianus, a patrician and former prefect of Rome, the highest official of the city. Around 416 AD, During the final decades of the besieged Western Empire, Nematianus fled Rome, abandoning his duty to defend the citizens he was sworn to protect. He ran toward southern France, likely taking gold and troops, intending to establish a private fiefdom. This act of personal financial and physical withdrawal was replicated by many powerful Romans, including Emperor Honorius, who fled to Ravenna. The governing class prioritized personal security over state stability. This purposeful abandonment was facilitated by willful ignorance. Roman elites systematically underestimated external threats, failed to integrate necessary settlers, and allowed pervasive political corruption. As concentrated wealth fueled political polarization and economic insecurity, the physical and financial withdrawal of the elite into fortified compounds became the final expression of civic betrayal. When institutions and shared prosperity fail, the state loses the broad-based legitimacy necessary to withstand shocks. The modern parallel is clear. Elite withdrawal into private bunkers and offshore accounts signals the same moral collapse that preceded Rome's fall. When those who govern prioritize escape over responsibility, the system has already entered terminal decline. Japan's economic bubble of the late 1980s provides the technical warning about asset distortion, speculative financialization, and policy paralysis. Analysis of the Japanese Nikkei and the U.S. S&P 500 demonstrates they experienced nearly identical booms leading to their respective peaks, with real estate markets following similar trajectories. The U.S. market is currently displaying the same asset inflation characteristics that preceded Japan's collapse. The Japanese bubble was driven by Zytec, financial engineering, or corporate speculation. Low interest rates, promoted by government policy, incentivized aggressive borrowing. Corporations didn't borrow to expand productive capacity. They borrowed to gamble on soaring stock markets and real estate values, using subsidiaries to hide profits and manipulate balance sheets. This frenzy led to absurd valuations. At the bubble's peak, Tokyo's land was estimated to be worth more than all land in the United States. Bankers, needing profit amid low rates, aggressively expanded lending without careful risk assessment, relying on inflated land as collateral. They shifted lending to second- and third-tier companies as blue-chip firms raised capital directly on the soaring stock market. This policy-facilitated cycle of speculation and poorly monitored lending created systemic risk. The danger wasn't just corporate gambling. It was the financial sector's complicity in funding speculation with borrowed money, creating leverage that amplified both gains and losses. The ultimate tragedy wasn't the bubble's burst, triggered when the central bank raised the discount rate to 6% in August 1990, but the decades of stagnation that followed. Policymakers failed to prick the bubble while it expanded, then struggled for years to manage the toxic asset overhang and deflationary spiral despite implementing massive monetary easing and substantial fiscal stimulus. The stagnation couldn't be explained by normal business cycles. Deeper structural factors were at play. Japan's economy entered a deflationary trap where debt remained while asset values collapsed, leaving corporations and banks paralyzed. Japan's experience delivers a crucial lesson for the United States. While Japan had a bank-based financial system, the U.S. market-based system is susceptible to identical asset bubbles, as shown by the S&P 500 parallel. The challenge for U.S. policymakers isn't preventing the crash, but preventing the subsequent years of stagnation caused by policy paralysis and failure to address highly leveraged corporate debt and inflated equity valuations. Zytec exemplifies the shift from productive capitalism to speculative rent-seeking. When financial success concentrates in complex, speculative instruments, it diverts capital from necessary long-term investments, transforming the capitalist system into a casino benefiting the elite. The modern American economy exhibits a dangerous synergy, simultaneously displaying the political capture of the Gilded Age, the asset distortion of Japan's bubble, and the moral detachment of late Rome. The fusion creates systemic fragility on a scale unseen in modern history. Deregulation and tax cuts have elevated earnings for the few while Market volatility generates enormous profits for sophisticated financial players. This environment combines Gilded Age political favors with Japan's speculative philosophy, accelerating wealth accumulation at the top. Critically, the U.S. system shifts relatively little income from higher-income households to lower-income households via taxes and transfers. This architecture is specifically designed to maintain the inequality that fuels financial fragility. Concentrated wealth doesn't sit idly. It organizes to achieve political ends, proving to be a key cause of constitutional dysfunction and political gridlock. Studies show that increased lobbying reduces a corporation's effective tax rate by between 0.5 and 1.6 percentage points in the following year. One study found that a $1 corporate campaign contribution is worth $6.65 in lower state corporate taxes. This demonstrates a powerful, measurable return on political investment. This political capture explains legislative gridlock over critical issues like Medicare, Social Security, and campaign finance reform. The beneficiaries of the current fragile structure control the mechanisms of potential correction, guaranteeing inertia that parallels the Gilded Age's inability to self-correct. Wealth doesn't just influence politics, it determines outcomes. When legislative action threatens elite interests, organized wealth mobilizes to block reform through lobbying, campaign, contributions, and media influence. The convergence is quantifiable. The late Western Roman Empire suffered hyperconcentration and breakdown of social bonds, leading to elite self-preservation and desertion of official posts. The U.S. Gilded Age suffered industrial monopoly and worker exploitation, leading to elite contempt and explicit rejection of public welfare. Japan's bubble suffered speculative asset inflation and cheap money, leading to short-term greed and aggressive lending without risk assessment. Modern America suffers from unmerited wealth, financialization, and elevated equity valuations, leading to political capture and lobbying-driven constitutional gridlock. Tax policy lobbying reduces effective rates for the wealthy, mirroring Gilded Age manipulation of tariffs. Regulatory gridlock prevents late legislation limiting monopoly power, echoing the Gilded Age's inability to enact antitrust laws without external shock. Financial deregulation facilitates risky instruments and systemic instability, replicating Japan's aggressive, poorly monitored corporate lending. The moral vacuum today is an evolution of Vanderbilt's open contempt. Modern business leaders offer muted public criticism, reflecting strategic hope that conditions won't go too far. This self-assurance mirrors the willful ignorance of late Roman patricians who prioritized isolated safety. The American elite, long insulated by political and financial capture, now face the critical Roman choice: defend the system they govern or confirm abandonment by retreating to fortified financial and physical fiefdoms. Contemporary U.S. systemic vulnerabilities are critically elevated across every dimension that preceded historical collapses. First, inequality peak. The U.S. retains the highest income inequality among peer nations, compounded by a tax and transfer system that fails to shift wealth downward. Second, asset bubble warnings. Elevated equity valuations relative to GDP and increased corporate leverage indicate speculative distortion mirroring pre-1989 Japan. Third, debt addiction. High inequality links directly to higher household and corporate debt, implying increased risk of financial crisis across the non-financial sector. Fourth, political gridlock. Documented political capture by organized wealth paralyzes the state, rendering it incapable of implementing corrective fiscal or regulatory measures, echoing Gilded Age inertia. The high prevalence of unmerited rent-seeking wealth, 60% from inheritance, cronyism, or monopoly, signifies structural decay of competitive markets. Capital channels toward extraction and speculation rather than productivity, fulfilling the economic prerequisite for Gilded Age-style collapse. This shift matters because productive capitalism generates broad-based prosperity through competition and innovation. Extractive capitalism generates concentrated wealth through political access and structural advantage, creating winners and losers based on position rather than performance. The U.S. system is fundamentally prone to policy failure because the mechanisms required for reform, Congress, regulatory bodies, the IRS, are institutionally captured or financially influenced by the beneficiaries of the current fragile structure. This internal capture guarantees policy paralysis akin to Japan's lost decades, where correction is impossible until after a devastating financial shock. The feedback loop is complete. Concentrated wealth generates political capture, which prevents reform, which allows further concentration, which deepens capture. Historical systemic failures are rarely gradual. They're preceded by long periods of structural decay, then triggered by sudden, often unexpected external shocks: the Panic of 1893, the Punic Wars, an emperor's assassination. The current structural convergence, political capture, speculative assets, social detachment, means the U.S. economy possesses extreme, non-linear sensitivity to inevitable rupture. The structural conditions guarantee that the correction of the billionaire boom will take the form of systemic de-oligarchization. History shows that extreme inequality corrects itself only via catastrophic systemic shock, imperial collapse, or Great Depression. High levels of debt and asset inflation combined with state paralysis validate the proposition that the United States is next to face violent structural reset, forcibly dismantling the current architecture of concentrated wealth. 3 separate civilizations followed this pattern to collapse. Each believed they were exceptional. Each believed the rules didn't apply. Each was wrong. The pattern doesn't depend on ideology or geography. It depends on structure. When wealth concentrates beyond a critical threshold, it generates political immunity. When political immunity prevents correction, the system absorbs tension until catastrophic failure becomes inevitable. The billionaire boom isn't prosperity. It's a pre-collapse signal, validated by centuries of historical precedent. 60% of this wealth is structurally unmerited, derived from inheritance, monopoly, and cronyism rather than competitive innovation. This concentration metastasizes into financial fragility through increased leverage, elevated asset valuations, and complex, opaque financial structures. The ultra-wealthy don't just benefit from the system, they control it, using lobbying and campaign contributions to dictate policy and ensure self-insulation from systemic risk. The U.S. system shifts less income from high to low earners than any peer nation, maintaining inequality that statistically primes the economy for financial crisis. The financialization trap is operational. Rising inequality drives household borrowing, corporate debt, and asset speculation, creating the feedback loop that inflates bubbles far beyond real growth. Inequality must be viewed not as social misfortune, but as definitive, quantifiable financial hazard. Academic theory establishes the direct mechanism. Higher wealth inequality increases the probability of systemic, self-fulfilling bank runs by incentivizing both poor and rich depositors to flee simultaneously. The U.S. has completed the key stages visible in every prior collapse. Extreme wealth inequality exceeds pre-revolutionary France. Political capture through lobbying and campaign finance creates constitutional gridlock. Asset bubbles mirror Japan's pre-1989 distortion. Elite detachment into private compounds mirrors Rome's abandonment. The only remaining question is timing. The structural conditions are locked. The pattern says collapse is coming, and when it comes, it won't be slow. It will be sudden, a currency crisis triggering a debt crisis, triggering a political crisis. Overnight, the superpower becomes a cautionary tale. To avert catastrophic policy paralysis and the violence of systemic collapse, the policy focus must shift from measuring growth to proactively reducing fragility. The imperative is dismantling the institutional architecture of concentrated wealth, Aggressive reinforcement of antitrust laws is necessary to break up wealth derived from market dominance. Tax policy must aggressively target inherited and financialized wealth, reversing generational transfer that cements aristocracy. Comprehensive campaign finance and lobbying reform is required to sever the direct link between wealth and legislative outcomes, addressing the core driver of gridlock and institutional self-sabotage. The United States still possesses agency to choose reform over ruin. Failure to implement profound structural policy changes guarantees that the current elite will, through inaction and continued political manipulation, confirm their historical role as architects of the next systemic collapse. The pattern has played out 3 times. Each time, the elite believed they were different. Each time, the pattern won. The 472% billionaire boom isn't a metric of success. It's a siren of structural failure, validating the cyclical nature of oligarchic decay. The crisis isn't theoretical. The mechanisms of financial fragility and political impotence are observable and statistically measurable. History doesn't repeat because humans forget. It repeats because the structures remain unchanged. And right now, America is building the same structure that collapsed 3 times before. The question is whether anyone will act before the pattern completes itself once more.